Welcome to the Teaminvest Wealth Builders podcast, where we bring you insights, strategies, and stories to help you build and compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. Whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. In this episode, we challenge the conventional wisdom of diversification, especially for investors. While diversification is often seen as the ultimate risk management tool, too much of it can dilute returns, mask hidden correlations, and create unnecessary complexity. We explore when diversification becomes a drag on performance, the hidden risks of portfolio bloat and overlap, how to focus on high-conviction strategic investments, and why sophisticated investors must rethink safe portfolio structures. If you're managing significant capital, this conversation will help you strike a smarter balance between risk, focus, and a long-term wealth creation. With me today, I have our CEO, Andrew Coleman, and our Head of Funds Management and Education, Sanjay Narendran. Now, let's start with this word, diversification. What does it actually mean? The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Okay, let's start the conversation with a look at what diversification is. Andrew, can you help us understand what is diversification?
Yeah, absolutely. Look, diversification in economics and finance theory is simply the idea that by holding a large enough bundle of uncorrelated assets, you can remove any of the company or industry specific ups and downs associated with those individual assets. So the idea effectively in economics and finance is that there are two types of risks that all assets are exposed to. There is systemic risk, a risk in the general economy, a risk of world war, a risk of interest rates moving. And then there is company or industry specific risk, the idea that that company's strategy will succeed or fail, or something related to that company's product or service will do well or do poorly. And so in theory, you can eliminate the chance that you as an investor are exposed to those company specific risks, the risks associated with that asset, by holding a large enough pool of assets, which makes sense. You know, if you own one asset, you are exposed to both the systemic risk, what's going on in the general economy, and the industry or company specific risk, what's happening in that industry, what's happening in that company. If you held, say, at another extreme, 1,000 assets, or you hold all 2,000 stocks on the ASX, then you would, by definition, have removed all your risk associated with the individual companies and industries, and instead be exposed only to the risk that the general market moves up or down. And of course, when you think of risk in an academic framework, where risk is equal to volatility, that idea that the return that an investor gets or an asset owner gets is different from the one they expected, then, of course, having a diversified portfolio, an extremely well-diversified portfolio that removes any of the individual unsystemic risk associated with an individual asset or an industry is a net benefit, because the net result is you'll end up with a return that was very easily predictable. Doesn't necessarily mean it will be a good return. What it says is it will be a predictable return. There'll be no volatility in that outcome.
So if we take what you've just said, we have a look at diversification, we'll have heard other terms thrown around such as asset allocation. And really that's what we're talking about when we talk about diversification. We're talking about, okay, where are we placing those assets and where have we got those spreads? Now, we also talked about risk management in there as well. And risk management is simply, are you going to get what you expect? And the probability of you getting what you expect. Is that correct?
Yeah, absolutely. And of course, on the one hand, that's really good, right? Like, no one wants sticker shock. No one wants to think they're going to retire with $500,000, $1 million, 10 million, whatever the number is, and end up with a number different. The problem, of course, though, is that in economic theory, we treat risk as bidirectional. In other words, we treat risk of upside exactly the same as we treat risk of downside, which is really good for the academics and the maths, and it makes our life much easier. But in reality, of course, is not the way the world works. You know,
It's your money.
absolutely right. Like if you thought you were going to retire with $1 million and you actually retire with 5, that's not a bad thing. But in economics, it would be awful because you would have achieved a 500% outperformance from your expected return, which is massive volatility.
Yeah.
On the other hand, if you thought you were going to retire with $1 million and you end up with 750,000, you would think that's probably pretty bad for you as the retiree. But in economic theory, that's better than the $5 million case because your result was closer to the expected result. So your deviation, your volatility from the average, from the expected number was closer. Of course, this is the problem of where, as in many fields, academic insight, which requires you to, treat all sides equally so that you can create a model that you can apply, sometimes contradicts with the reality of what people on the ground would like.
And because academics coin and define these terms and define the methodologies.
Well, it's esoteric, right? So there's this idea that, and it's true, right? Like if you believe that if you've defined risk in an academic construct as the chance that you get, as Kerry, you put it, and a result different from what you expected, well, then 750,000 is closer to $1 million than 5 million is. So the model was more accurate. So from the academic construct, it's completely right. Yeah. And this is the difference sometimes when things come out of academia and then get misunderstood by the general public. In academia, it's very well understood that volatility is just difference from expected outcome. It's not necessarily a bad thing. Yeah. The bad one is the standard deviation, which is the individual directions of that. So in other words, you don't want you don't want risk to the downside of your return, but you're okay with risk to the upside. The problem, as so often happens, though, is that what is an academic construct gets taken by regulators and market participants and journalists and turned into a truth without understanding the underlying side of it. So, when you're dealing with people in academia and professors of finance and economics, they do not believe that getting 5 million when you aim for 1 is bad. It's just, it has a volatility. Volatility itself isn't a problem, but there was volatility in the outcome. In other words, your original prediction was wrong by a lot. What happens, though, is once regulators get their hands on that, these words become dirty words. So volatility becomes a bad thing, and we talk about maximizing the risk-adjusted return or minimizing volatility in our portfolio. And that's, sorry to be a bit colloquial, total crap. You don't want to minimize volatility in your portfolio. What you want to do is minimize the risk that you don't achieve the minimum outcome you wanted.
Yeah.
But that's harder to say. It's less easy to just, distribute and describe. The maths is a lot harder to work out the individual direction of the risk. And so we stick with things like volatility and, we end up with bad outcomes for investors, but that's not a problem. And, it's funny because I know with your background originally as a financial planner and Sandy, your background as a broker originally, but if you told your client you would make $100 on a trade or you would retire with a certain amount of money, and they retired with that amount of money, they were happy. Yeah. Or they made that money on the trade, right? They were happy. If you told them there's a chance you can make 4 times the money and they didn't, they only made double their money, they were upset because they'd been anchored on 4 times the gain. So there becomes this incentive inside industry to underpromise and then meet those very low promises. Because you get no extra benefit. If you sell to someone, you'll get 5% per annum until you retire and you get them 9, you don't get any flowers or chocolates or thank yous. You just get told that's what I paid you for. But if you tell them you're going to get 9% and they get 8, they're angry. Even though in that scenario, they are materially better off having averaged 8 for the course of their investment with you versus 5. So there becomes this incentive to chase the bottom return and then meet that, set expectations low and deliver. And of course, the biggest example of this in Australia right now is the industry super funds, who have made a huge play for the hearts and minds of Australians and seem to have won on the basis of massively under-promising, achieving incredibly anemic results, way worse than anyone else in the market is getting. But then, compare the pair and they argue that they're better off because they set the expectation low.
They achieve the results that they set out
Absolutely.
Absolutely. As low as those results were. Sorry, Sanj.
Not only that, but since all this research is coming out of academia, you would have known in all the courses that you've done and I've done and you've done as well, Andrew, that all of the content is based on reducing the risk. It's all built in. These defined terms, that risk reduction, it's all the academic concept But when it flows out to an advisor that is getting qualified and you're graduating and learning through uni and your courses that you do after that, it's all built into the syllabus that this is the way you need to operate,
Absolutely.
because they can't define and educate the population on doing more risky, or in their defined terms, more risky behavior. It's just because they don't have the wording and the ability to pass on that message that way.
Yeah, look, and I don't blame it. I mean, these are very complex topics that have multiple Nobel's prizes associated with them, right? Like the idea that we're going to get that publicly understood is, I'm living in dreamland, right? But just to point out the sheer absurdity of it, if you have an investment strategy that guarantees failure, you'll lose all your money, and you deliver that, you lose all their money, the volatility was zero. On the other hand, if you have an investment strategy that promises tripling someone's money and you only double it, you will get hammered by regulators for having too large volatility in your product.
Yeah.
Now, that's true. You promised 3 times, you delivered 2 times. So I agree there's an issue here, a mismatch between what was promised and what was delivered. But doesn't that then just create the wrong kind of incentive as an investor? So think of it not as the firm for a second, but the incentive for the investor is to maximize the total money you have, the total wealth you have over time for the risk you're prepared to take. The real risk, the risk of losing the money, not some academic construct of risk.
Yep.
On the other hand, the incentive when you minimize volatility is to guarantee a return regardless of what you've potentially given away. So leaving your money in the bank is considered, and is correct in economic theory, as long as the bank is, safe, to be the lowest volatile asset class you can hold, cash. Why? Because it doesn't give you anything. It doesn't go up. It doesn't go down. Sometimes it goes up by a very small amount if the bank offers you a very tiny, return. But the point is, there's a locked-in number. There's no chance that you don't get it. The problem is almost certainly that number is less than inflation. So your wealth over time declines in real terms, but you had no volatility. There was no risk that the number was different.
Yeah.
On the other hand, investing in the stock market is considered of the major asset classes to be the riskiest. Why? Because the stock market moves up and down every day. There is constant volatility. And yet over the long run has outperformed the cash and bond market by orders of magnitude for 100 plus years. And this is also known. Financial advisors will tell you this. I'm not saying anything out of school here, right?
No.
But we see the market, because that's what theory tells us, as more volatile. It is. Prices move every day. And therefore, we say it's a risky asset. Well, that depends. If the long run average for the stock market has been about 8.5% for the last 100-odd years, and you can sort of look at it in any 20-year period, roughly it's about the same, but it's about that, then if you're a long-term investor, where's the risk? The risk is that you achieved a badder period and got 8%, as opposed to a better period and got 9% by holding the index. But that's still 3 times what cash has given you in any period. It's more than double what the bond market has given you in any period. So you have higher volatility, but greater wealth.
Yeah.
And so, the question always comes down to, I think this is what you were wanting to get through to today with diversification. If you've got to take the second order step and say, well, if the economic theory tells us this is a concept, how can we apply that concept to us? And so really, what does diversification mean for you as an investor? Well, really, I think it means 2 things. The first one is purely colloquial, which is that idea that you want to have enough different assets, if they're asset types that suit you fine, or different stocks or different bonds or whatever it is within an asset class, that you could feel comfortable if you made a wrong decision, because we're not going to get them all right. So, if you've got all your eggs in one basket, as the lovely old saying goes, you're in trouble, right? Drop the basket, all the eggs break. On the other hand, if you've got, say, take another extreme, 1,000 assets, well, getting any one of them wrong probably doesn't matter to you. But on the flip side, and this is the important point, so too does it limit the benefit of getting any of them right. If you have only one asset and you get it right, you can make a lot of money. You've got big risk, though, that you didn't get it right. If you've got 1,000 assets, you get no benefit for getting one right, but you also take no risk on getting one wrong. So how many assets should you hold? Well, that's really a personal question. Economic theory tells you that from the time you get to about 8 assets, if they are perfectly uncorrelated, you have minimized all non-systemic risk. Yeah, it's lovely in theory. It's irrelevant in practice, right? Because nothing is perfectly uncorrelated. And I don't know about you, but with 12.5% of my wealth which is 100 divided by 8, right, in any one asset, I wouldn't sleep that easy. So I get the idea that 8's not enough. So how many should you hold? Well, how many do you feel comfortable with? And I think the question you should ask yourself when you look at that is 2 questions. Number one is, what percentage of my wealth would I be prepared to lose on a mistake? If it's, say, 4% of my wealth, well, then that means 25 assets. If it's 10% of my wealth, it means 10 assets. That's how do you sleep at night? There's no academic basis behind that. It's purely gut feel, making your life easier. And then the second question you should ask, which I think is even more relevant, but still important, is how well can I understand that number of assets? Because our biggest risk in investing, and Sanjay, you and I talk about this a lot, and I'm sure you'll add some commentary, is not so much that we make a wrong decision at the time. It tends to be, if you've done your research, your decision at the time is pretty good if you've taken advice from good people. The problem is the world isn't static. Things change. And so your bigger risk as an investor tends not to be you chose wrongly on day one, but it tends to be that something happens between day one and you exiting that materially changes the asset you were in. Now, if you understand the asset well and you're following it closely, you'll see that and you'll be able to get out before the damage is deep. If you're not following the asset, you've put it in the top drawer and completely ignored it, or you don't understand it, it's in an industry or a technology or a space or a country that you just don't have any affinity with, then the odds of you picking that up are very low, and therefore the damage is likely to be higher. And in the lending market or the bond market, you talk about loss given default, which we don't talk about in the stock market. But what loss given default is, it's how much money will I lose if this person defaults? Which is actually the right question to be asking. It's not what's the risk of default. That's only one part of the equation. It's if they default, how much will I lose? And that's the bit around investing that I think so often is ignored. It's not, will I get the decision wrong? The answer is some of them, absolutely. We're all human. The question is, what is my loss if I get it wrong?
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
This is probably a good time to actually introduce a term that was coined by Warren Buffett, diversification, as opposed to diversification. So let's bounce off that. Sanjay, what is diversification?
Well, I think it's basically what Andrew was describing before. It's the habit of the financial planners and people in the industry that if you keep diversifying, you will basically get the average returns. You're going to keep diversifying. You go more than 8, you go more than 20. You keep, the more you have in that portfolio, you're going to offset and reduce your risk by doing it. But at the same time, you've worsened that portfolio because you've really capped out your gains. So the more stocks you have, yes, you've reduced the number of when they go down, you'll have other ones to offset them as they've gone up. But the more you're offsetting your gains, wouldn't you rather just invest in the ones that go up rather than the ones that go down?
Yeah, Buffett talks about it. He says, if you have 10 brilliant ideas and you have certainty in a theoretical world that those 10 ideas are great, why the hell would you want to own 11 things? Because the 11th one has to be worse than the other 10 that you own. So, in theory, every time you add a new idea to your portfolio or a new stock, a new asset class that you don't understand as well and you're not as certain of, you worsen the results of the portfolio. You reduce the volatility of the portfolio, but you do so by taking out the upside. And remember, volatility is bidirectional, right? So you go from, I was going to get 20% per annum to I'm now getting 15. Well, yes, that's less volatility relative to the market, but it's 5% per annum less money. You've achieved reducing volatility by giving up upside.
And from a practical aspect, how many assets can we really understand at one time?
I think it's reasonable to expect that you understand an asset really well. There's levels of understanding within an asset. If you have a basic competency around it, you understand the landscape and you can make sense of it, because maybe it's a simple landscape to understand, then you can know maybe 10, 15 of those. But then to get into something that you know really, really well, then maybe there's probably about 8 to 10. That's in my opinion. 8 to 10 really well, and then an additional amount, enough to make an informed investment decision, but maybe not as well as the others. And that's probably, given everybody's circle of competence that we talk about, that if you've been in an industry, if you've been educated through an industry, you've seen the ins and outs, and you've worked in that landscape for a while, you're going to understand it a lot better. If people are around you there and you've got access to information from people from that industry, you're going to understand that landscape a lot better than, for me, being in financial services and only living in Sydney. I don't really understand mining to the extent that somebody else will, especially people over in WA that I've met, some of our members over there. They understand the mining landscape way, way better than I do. But it's all about that the core competency of where you are. But I think about 8 stocks is probably a reasonable amount to know fairly well.
Yeah, I think it depends on the individual person, right? I think there's certainly a floor and a ceiling, right? I don't think there's anyone out there who's dumb enough that if they put a little bit of work in, they couldn't get to understand at least 8 or 10 companies or industries or asset classes, whatever you want to look at it as, pretty well. I mean, this is not rocket science for a lot of stuff. Like, how hard is it to understand a bank deposit? Well, now you've got one already, right? How hard is it to understand a government bond? Well, now you've got 2. An index fund, 3, right? This is not rocket science at the basic end, but there is also a ceiling. And I genuinely believe that no matter what some people say about AI and super geniuses, no one is smart enough that they can understand fully and be up to date on something like 60 or 70 different assets or asset classes. If you're being forced to cover 60 things, just think about how many minutes a day that gives you to look at it. The odds are you're going to miss stuff. So, my gut feel is that for the average person, the portfolio size that would make you comfortable, as in, I could afford to lose that percentage if it went wrong, but also I feel at least I have some understanding of what's in. I may not be a genius about it, but I can at least sort of follow it well enough that I'm not going to get blindsided. Probably means somewhere between sort of 15 and 25 assets or stocks or whatever you want to look at it in your portfolio. Less than 15, I think, yeah, you understand them really well, but you're starting to take larger risk that one of your investments fails. 15, it's 6-7%, right? So, it starts to get a bit scary. And at 25, it starts to get hard to really say hand on heart, I'm following that. I know everything that's going on. I'm not going to get blindsided. So my sort of personal feel is it's 15 to 25. I tend to be a bit more high conviction than most, as sort of we would call it. So I tend to sit towards the bottom end of that spectrum, just because I feel like I can deep dive and know stuff quite well, but it's a personal choice, right? But I think, economically, from a theoretical point of view, Sanji's right, sort of 8+, you start to limit the benefit of any upside. The challenge, of course, is being comfortable enough that more than 10% of your money is in any one thing. And so therefore, totally understand going beyond it. But, if you looked at it as you had a family home, you've got some money in the bank, well, that's already 2 asset classes. And then you had 8 or 9 stocks on top. Well, you're actually not there with 8 or 9. You've got 11 because you've got the other things as well. So you've got to do what makes you comfortable. But I think the 2 things you want to be aware of is, number one, risk only matters on the downside as an investor, as opposed to an academic theory. So if you know an asset really well and the risk is that it does better than you think, that's not a bad risk. The risk is that it does worse than you think. So think of it in reality rather than in theory around volatility. And then the second thing about it is, if you're going to put your money, a reasonable amount of money, into anything, you want to know it pretty well. And you don't want to then take your brilliant idea and diversify it by throwing in 5 other bad ideas because you just felt you should. So, that point of Buffett's, I think, really doesn't get understood enough and is so incredibly apt. But, if you've got an edge in an area, you come from the finance field or the mining field or the medical field or the tech field, and you really understand that group of companies. Yes, financial planners will tell you shouldn't have more than, say, 2 from that industry in your portfolio. That's because they have to assume you don't know anything about it. But if you're an expert, a deep expert, go hard in that field, as long as you're comfortable that if you get it wrong, you can live with the reality. But you are odds on going to do better by sticking to your area of competence and running with your great idea heavily than you are by running with everyone else's bad ideas.
So it's almost that intelligent risk taking.
Absolutely.
Yeah. It's just how much time you're going to spend into something and the rewards that you're going to expect back.
Yeah.
So if you're going to invest your time and understand the business or understand the asset class or whatever it is, you can expect a higher return for that because you've now invested that time to get that higher return and you understand the landscape around it. Whereas if you don't want to invest all that time to do it, you just want to put the money somewhere, then you diversify and be spread across and just expect mediocre returns.
Yeah, the whole argument around diversification reminds me of that lovely old statistics joke, right? But there's a pirate and they capture 3 sailors, maroon sailors. The one is an ex-lawyer, the one's an ex-banker, and the other one's a statistician. And the pirate says to the 3 newly captives, we have a tradition on our ship that if you can stand at the bow of the ship and shoot an arrow and hit this little tiny mark on the mast, then we'll let you go. And if you lose, and if you miss, you work effectively as slaves on our ship in the galley for the next 10 years. So the lawyer goes first, he pulls a bow back, he aims, he shoots, and he misses by an inch to the right. The ship has just moved and all disappointed. The banker, or doctor if you want him to be, stands up, shoots, and misses by an inch to the left. The swell's the other way, and the pirate turns to the statistician and says, "Your turn." And the statistician says, "I don't need to shoot." Pirate says, "Why?" And the statistician says, "We've already hit it." The average of the 2 shots. And I think that's the problem sometimes with diversification and these academic concepts, right? Is that in that case, that is perfectly accurate from a volatility perspective. Person A shot and missed by an inch to the right. Person B shot and missed by an inch to the left. So the volatility of the portfolio was perfectly cancelled and you achieved the bullseye. But in reality, that's not bullseye. It's 2 misses. That's the difference. Now, from a standard deviation perspective, by the way, this is the music on the math side. From a standard deviation perspective, that's an average. From a volatility perspective, which is why we use volatility, it's a double miss. So the maths is right, hence why we use volatility in the equation. But we've forgotten that we're not solving how much did we miss a bullseye for. We're solving how much money did we end up with. So if that had not been right and left, but it had been up and down on, for example, an expected return, then only one of those 2 was a bad outcome.
Yeah.
Shooting an arrow at a target, they're both misses.
Yeah.
That's the failure in taking the academic concept and applying it to your own portfolio.
So I think today we've spoken about diversification, we've spoken about diversification, and then we've also explored concept around risk, what risk-taking actually is, and how we understand it from an academic perspective, but also from an in-reality perspective. Is there anything else that you would like to leave our audience with today, Sanjay?
Yeah, look, from a practical, real situation perspective, as people know, I look after the funds here. Now, as a fund manager, if we're going to go out and promote our fund, which invest in equities and it's purely equities, the legislation, the regulation, everything has a criteria about how we're going to score it. Now, going through that criteria, I have to look at it as a really high risk because it's a purely equities portfolio and it is not following the diversification that's required to be a passive fund or a hugely diversified index tracking fund or something like that. So by definition, from a legislation point of view or a regulation point of view, I've got to put it and class it as a high risk. But because they're businesses and companies that the investment team know really, really well, and we are confident and have the ability to understand those landscapes and those environments that those businesses operate in they're more high conviction for us. For us, we see that as a lesser risk, but we can't classify it that way. So when you're going out, I think it's the easiest thing to sell, to say, go out with a mediocre portfolio, getting an average of 8-9% returns, and having huge diversification, and basically not have to worry, because that way you reduce your exposure, reduce your costs, go out and you can get that fund flow in, but you don't really do much for your investors.
So the key takeaway is really to understand what you're investing in.
Yeah.
Not just look at from a surface regulator point of view, but to actually understand. And it comes back to when we talk about, we started with diversification and saying, you know, understanding what you're invested in, and truly understand when we're talking about being invested in equities, understanding those companies. If we take it up a level, it's truly understanding what you're investing in. If you're going to invest into a managed fund, then it's understanding, what does that fund actually do? How is it looked after? How are your funds invested?
Absolutely. Just anything that you're going to put your money in, just get to know, do your due diligence on it.
Yes.
And the more that you investigate and understand it, and more due diligence you do, the better returns you should be expecting.
Absolutely. Well, thank you, gentlemen. Appreciate your wisdom and your insights today.
Thank you.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.